Good day, welcome to the last part of Chapter 2, and for this video presentation, we will focus on the discussion of different financial ratio that are used by different business organizations in analyzing financial statements. Ratio analysis refers to the analysis of various pieces of financial information in the financial statement of the business. They are mainly used by external analysts to determine various aspects of the business such as its profitability, liquidity, and solvency. Financial managers and analysts are commonly use ratio analysis for comparison, trend line, and operational efficiency. In this video presentation, you will learn how to use financial ratio as a technique when analyzing financial statement. The first financial ratio that we will discuss for this presentation is the liquidity ratio. Liquidity ratio is also called a short-term ratio. This ratio helps to understand the liquidity in the business, which is the potential ability to meet current obligations. This ratio expresses the relationship between current assets and current liabilities of the business during a particular period. Always remember na kapag ang pinag-uusapan natin ay ang liquidity ratio ng isang company, we can use either current ratio or quick ratio. Again, ginagamit natin ang liquidity ratio para malaman ang capacity ng isang company na ma-meet ang kanilang current obligation. So let us first discuss the current ratio. The current ratio measures the ability of your business to pay your current liabilities using your current assets. While there are many assets types, you only include current assets in your current ratio calculations. Current assets are assets that can be converted into cash within 1 year. Current assets may include the following. So we have cash and cash equivalents, we have account receivables, prepaid expenses, inventory, and securities. So look at the given example. So we have the comparative statement of financial position of the Pinoy Pride Handicrafts. By the way, kapag current ratio at quick ratio ang i-compute natin, we will be using the balance sheet as our point of reference. To compute the current ratio, we need to consider its formula, current assets over current liabilities. Then we will just substitute the value of the given formula. So we have 22.87 as the current ratio of Pinoy Pride Handicrafts. This shows that for every 1 peso that the company have in their current liabilities, they have 22.87 pesos worth of current assets. Take note that a good current ratio is 2. Indicating you have twice as much in assets as liabilities. A current ratio of less than 2 may indicate financial issues and an inability to pay off current debts, while a current ratio over 4 may indicate that your business is not using its assets efficiently. In our given example, the computed current ratio is 22.87. It means that the company is not using their asset efficiently. Another one is the quick ratio. Take note that when computing the quick ratio, you need to consider those quick assets of the company. So meaning ito yung mga assets na madaling i-convert into cash or its cash itself. All current liabilities should be included in the calculation for the quick ratio. So in our given example, the computed value of the company quick ratio is 21.63. It means that the company do not use the assets efficiently. It's recommended quick ratio be at least 1, indicating that for every peso you have in liabilities, you have 1 peso in your assets. As with the current ratio, a quick ratio of less than 1 indicates an inability to cover current debt, while a quick ratio is too high may indicate that your business is not using assets efficiently. So ano nga ba ang pinagkaiba ng quick ratio at ng current ratio? So I would like to reiterate that both the current ratio and the quick ratio are considered liquidity ratios. They are measuring the ability of the business to meet its current debt obligations. The current ratio includes all current assets in its calculation, while the quick ratio only includes quick assets or liquid assets in its calculation. So considered the more conservative ratio, the quick ratio only considers assets that can be quickly converted to cash, whereas the current ratio also includes inventory, which is an asset but in most cases cannot be converted into cash within 90 days or less. The quick ratio indicates a company's capacity to pay its current liabilities without needing to sell its inventory or to get additional financing. So these are the two major ratios na kabilang sa liquidity ratio. Another ratio na ginagamit ng mga financial analyst ay ang activity ratio. It is called as turnover ratio, and this ratio measures the efficiency of the current assets and liabilities in the business during a particular period. This ratio is helpful to understand the performance of the business firm. So under this ratio, we have stock turnover ratio, we have debtor turnover ratio, creditors turnover ratio, and working capital turnover ratio. Isa-isahin natin ang different ratios under this activity ratio, and let's start with the stock turnover ratio. The stock turnover ratio is also known as the inventory turnover ratio, and it is an efficiency ratio that measures how efficiently inventory is being managed. The inventory turnover ratio formula is equal to the cost of goods sold divided by total or average inventory to show how many times inventory is turned or sold during the period, where the cost of goods sold is the cost attributed to the production of goods that are sold by the company over a certain period. The cost of goods sold by the company can found on the company's income statement, and the average inventory is the mean value of inventory throughout a certain period. Take note that the analyst may use either average or end of period inventory values. So the ratio can be used to determine if there are excessive inventory levels compared to sales. In other words, it measures how many times a company sold its total average inventory peso amount during the year. In this ratio is important because total revenue depends on two main components of performance. The first component is the stock purchasing. So if a larger amounts of inventory are purchased during the year, the company will have to sell greater amount of inventory to improve its turnover. If the company can sell these greater amounts of inventory, it will incur storage cost and other holding costs. The second component is sales. Sales have to match inventory purchases, otherwise the inventory will not turn effectively. That's why the purchasing and sales department must be in tune or coordinated with each other. So let us see the given example for stock turnover ratio. In the given financial data of JMN Corporation, the inventory for 2016 is amounted to 550,000. For 2017, it is 450,000. For the company's cost of goods sold or cost of sales is 800,000. Now, let us compute for the inventory turnover for 2017 using the given formula. Ang una natin gagawin is kunin muna natin yung average inventory. So we have 550,000 plus 450,000, it is equal to 1 million. Then i-divide natin sa 2. That will give us the result of 500,000. Now 800,000 divided by 500,000 is 1.60. Now ano ang ibig sabihin ng computed value na 1.60? So to better understand the interpretation of this computed value, let me present to you kung paano nga ba ini-interpret ang result ng inventory turnover. Now, to interpret the result or the computed stock or inventory turnover ratio, you need to remember the following. Number 1, inventory turnover ratio is an efficiency ratio that measures how well a company can manage its inventory. It is important to achieve a high ratio as higher turnover rates reduce storage and other holding costs. It is vital to compare the ratios between companies operating in the same industry and not for companies operating in different industries. So the benchmark ratio varies greatly depending on the industry. Number 2, low turnover implies that the company's sales are poor. It is carrying too much inventory or experiencing poor inventory management. Unsold inventory can face significant risk from fluctuating market prices and obsolescence. Number 3 is depending on the industry that the company operates in, inventory can help determine its liquidity. For example, inventory is one of the biggest assets that retailers report. If a retailer's company reports a low inventory turnover ratio, that the inventory may be obsolete for the company, resulting in lost sales and additional holding costs. Another ratio under activity ratio is the debtors turnover ratio. The debtors turnover ratio is also known as accounts receivable turnover ratio. It is an efficiency ratio that measures how efficiently a company is collecting revenue, and by extension, how efficiently it is using its assets. The account receivable turnover ratio measures the number of times over a given period that the company collects its average account receivable. It is just simply means that this ratio measure the number of times per year bago nila makolekta ang kanilang accounts receivable. The formula to compute the accounts receivable turnover ratio is accounts receivable turnover ratio equals net credit sales over average accounts receivables, wherein net credit sales are sales where the cash is collected at the later date. The formula for net credit sales is sales on credit minus sales return minus sales allowances. Then the average account receivable is the sum of starting and ending accounts receivable over a time period. Then, i-divide natin siya sa 2. So, let us have an example of account receivable turnover ratio. Trinity Bike Shop is a retail store that sells biking equipment and bikes. Due to declining cash sales, John Gibb, the owner, decides to extend credit sales to all his customers. In the year ended December 31, 2017, there were 100,000 pesos gross credit sales and returns of 10,000 pesos. The starting and ending accounts receivable for the year were 10,000 and 15,000 pesos respectively. John Gibb wants to know how many times his company collects its average account receivable over the year. So we have a formula for accounts receivable turnover ratio, that is net credit sales over average accounts receivable. In our given scenario, we have 100,000 minus 10,000 pesos, that is the gross credit sales minus returns, that will give us the result of 90,000. And then we have a 10,000 plus 15,000, and then i-divide natin siya sa 2 to get the average accounts receivable, and that is 12,500. Now, 90,000 divided by 12,500 will give us 7.2 as the accounts receivable turnover ratio of Trinity Bike Shop. Therefore, the Trinity Bike Shop collected its average accounts receivable approximately 7.2 times over the year ended December 31, 2017. Liquidity ratio is also called a short-term ratio. This ratio helps to understand the liquidity in the business, which is the potential ability to meet current obligations. This ratio expresses the relationship between current assets and current liabilities of the business during a particular period. Always remember na kapag ang pinag-uusapan natin ay ang liquidity ratio ng isang company, we can use either current ratio or quick ratio. Again, ginagamit natin ang liquidity ratio para malaman ang capacity ng isang company na ma-meet ang kanilang current obligation. So let us first discuss the current ratio. Next one is the creditors turnover ratio. So the accounts payable turnover ratio is also known as the payables turnover or the creditors turnover ratio. It is the liquidity ratio that measures the average number of times a company pays its creditors over an accounting period. So the ratio is a measure of a short-term liquidity and with a higher payable turnover ratio being more favorable. So the formula to compute the payable turnover ratio is net credit purchase over average accounts payable. So tingnan natin ngayon kung paano nga ba ginagawa ang payable turnover ratio. Take note that in some cases, cost of goods sold is used in the numerator in place of the net credit purchase. Average accounts payables in the sum of accounts payable at the beginning and end of an accounting period divided by 2. So take a look of the given example, then let's substitute the given figures to our formula. So we have company A reported annual purchases on credit of $123,555 and returns of $10,000 during the year ended December 31, 2017. Accounts payable at the beginning and end of the year were $12,555 and $25,121 respectively. Then the company wants to measure how many times it paid its creditor over the fiscal year. Therefore, over the fiscal year, the company's accounts payable turnover approximately 6.03 times during the year. The turnover ratio would likely be rounded off and simply stated as 6. Let's move now to working capital turnover ratio. Working capital turnover ratio helps in determining that how efficiently the company is using its work capital. So we have current assets minus current liabilities kapag kinuha natin ang working capital. So and it is calculated by dividing the net sales of the company during the period with the average working capital during the same period. It signifies that how well a company is generating its sales with respect to the working capital of the company. The two variables to calculate this ratio is sales or turnover and the working capital of the company. The working capital of the company is the difference between the current assets and the current liabilities. So let's have an example. So on our given example, we have company ABC with its financial information. Sabi nga natin kanina, to get the net working capital, we need to deduct the current liabilities to the company's current assets. So we have 6,062,132.07 for 2018 and we have 9,652,626.01 for 2019. So to get the working capital turnover ratio, net working capital is divided by sales revenue. So we have 1.27 for 2018 and 0.86 for 2019. Now, how are we going to interpret the results? A higher ratio generally signals that the company is generating more revenue with its working capital. When the current assets are higher than the current liabilities, then the working capital will be a positive number. It is also important to look at working capital ratio across ratio and also in comparison to the industry to make a good analysis of the working capital. Another one is the profitability ratio. It measures a company's ability to earn a profit relative to its sales revenue, operating costs, balance sheet assets, and shareholders' equity. So these financial metrics can also show how well companies use their existing assets to generate profit and value for owners and shareholders. It is composed of the following. Number 1 is the gross profit ratio. Number 2 is the net profit ratio, operating profit ratio, and the return on investment. Let us first discuss the gross profit ratio. It is typically the first profitability ratio calculated by the business. It measures how much sales income a company has left over after it covers the cost of goods sold, and this figure is known as the company's gross profit margin. you can calculate your company's gross profit margin with a given formula. So the initial figures you need to complete the formula should be available on your business income statement. In our given example, the gross profit margin of the company is 61.74% or 62% rounded off. So this means that for every dollar generated, $0.38 would go into the cost of goods sold, while the remaining $0.61 could be used to pay back the expenses, taxes, and different expenses of the company. Another one is the net profit ratio. Net profit ratio or net profit margin is also known as the net profit margin ratio, is a financial ratio used to calculate the percentage of profit of the company produces from its total revenue. It measures the amount of net profit of the company obtained per peso of revenue gained. The net profit margin is equal to the net profit, also known as net income, divided by total revenue expressed as percentage. So let's have an example of net profit ratio. Using the formula for the computation of net profit ratio, you can easily compare which of two companies has the higher net profit margin. So our formula is net profit margin equals net profit over revenue. So for company XYZ, we have the computed net profit margin of 30%. And for company ABC, we have computed net profit margin of 35.56%. Now, it means that the company ABC has a higher net profit margin. Take note that a higher net profit margin means that the company is more efficient at converting sales into actual profit. Next one is the operating profit ratio. It is the profitability or performance ratio that reflects the performance of profit of the company produces from its operations prior to subtracting taxes and interest charges. It is calculated by dividing the operating profit by total revenue and expressing as a percentage. So the margin is also known as EBIT or earnings before interest and tax margin. So operating profit is calculated by subtracting all the cost of goods sold, depreciation and amortization, and all other relevant operating expenses from total revenues. Operating expenses include a company's expenses beyond direct production costs such as salaries and benefits, rent and related overhead expenses, research and development costs, and others. So the operating profit margin calculation is the percentage of operating profit derived from a total revenue. As you can see on the given example, operating profit ratio can be computed by dividing the income before tax by total sales of the company. Operating profit margin differs across industry and is often used as metric for benchmarking of one company against similar companies with the same industry. It can reveal the top performers within an industry and indicate the need for further research regarding why a particular company is outperforming or falling behind its peers. Another one is the return on investment. ROI is a financial ratio used to calculate the benefit an investor will receive in relation to their investment cost. It is commonly measured as net income divided by the original capital cost of the investment. So let's have an example of the computation of return on investment. An investor purchases property which is valued at 500,000 and then 2 years later the investor sells the property for 1 million pesos. So ROI is equals to 1 million minus 500,000 then divided by to 500,000. It will give us the result of 1 multiplied by 100. It's a 100%. So a positive result such as an ROI like 25% means that return exceeds cost. Analyst or financial manager therefore consider the investment a net gain. The opposite kind of result, let's say for example a negative result of negative 25% means that cost outweigh the return. So analysts or the financial manager therefore view the investment as a net loss. Consequently, when comparing two or more investments and when the risk and other factors are equal, the investment with higher return on investment is the preferred choice. So for your assignment, search for the definition, purpose, and formula of the following and cite an example of each solvency ratio. So we have debt equity ratio, proprietary ratio, and interest coverage ratio.